We have the CPI data that's come in, and you can see on the bottom band of your screen that the November CPI inflation has come in at 0.7% versus 0.25% in October. Remember, the October numbers had come in at a record low, and this time it's come in at 0.71%, very, very close to the estimated figure of 0.7%, in fact. And the food inflation this time has gone to the positive territory at 3.91%, and that was in the negative territory at minus 5.02% in the month of October. So that's gone up, but the headline CPI inflation number definitely is at 0.71% versus the estimated figure of 0.7%. I have my colleague Vishwanath Nair, he's also the banking editor and Mumbai bureau chief of NDTV Profit, on the phone line to give us his first take on the CPI figures. Vishy.
Right, so as anticipated, the retail inflation is coming in at about 0.71%. This is widely expected by economists, actually. Some did expect a negative reading this month. However, it's coming now in the positive, slightly higher than the October number. Nothing to be concerned about or alarmed about in terms of the increase. October was an anomaly at 0.25%, so 0.7 is a reasonably normal figure. It's also inched up primarily because of food inflation that was widely expected as well. Over the last month or so, we've seen the prices of tomatoes rise, and tomatoes are an important contributor to the vegetable price inflation because there are three vegetables that this vegetable price inflation tracks: potatoes, onions, and tomatoes. In that, tomato prices have risen by double digits on a month-on-month basis. So that's obviously where this increase in food inflation is showing. Over the last few months, we have been seeing a negative number on the inflation, on the food inflation front, specifically on vegetable inflation front. Actually, vegetable inflation has been dropping quite a bit. That seems to have turned. There were unseasonal rains which have caused this. But going ahead for the whole financial year, it is expected that inflation will remain well within that 4% target. In fact, the RBI has estimated that FY26 inflation will be coming in at about 2%.
Understood. Understood, Vishwanath. I have Anubhuti Sahay, South Asia Economic Research at Standard Chartered Bank, joining us at the moment. Ms. Sahay, my first question to you is, what do you make of these numbers? Ms. Sahay, you're on mute. If you could just unmute yourself, please.
Am I audible now?
Yes, you are. Just wanted to get your first take on these figures.
So it's pretty much in line with expectation, even if we look at some of the breakdowns, like we don't have the full breakdown at this juncture, but some of the breakdown is also pretty much in line with expectation. We expected food inflation or disinflation to reduce. That has happened. Even if we look at core, we were expecting at 4.35%, while we still have to calculate it. Our sense is it's possibly close to our forecast. And there is a marginal upside tick in the fuel and lighting CPI. It was at 2%. Now it has come at 2.32%. So just a few things here and there, but I think more or less is pretty much in line with expectation. We were looking at 0.65%. So not, not much of surprises here.
Okay. Just one more question on the food inflation side. You did mention that the disinflation has reduced, but what do you think would the path would be in the future, in the long term, for food inflation especially? Because for a couple of months, it had been in the negative territory.
Absolutely. I think we will continue to see it moving higher and in the positive territory, mostly in the first quarter of 2026. For now, the base effect is still pretty strong, and that might help. I think for the more important part is how the headline number plays out, and our sense is that the headline number is likely to remain below 4% going till September of 2026. So even if food inflation creeps up, it's unlikely to be a big concern either for the market or the policymakers, because the headline inflation, which is the anchor of monetary policy, is likely to remain below the mandated medium-term target for the MPC.